You know other traders are making consistent money in the stock market. So what's it going to take to improve your trading results? Another indicator? Another strategy? You might get lucky once or twice with these surface adjustments. But for lasting improvement in your trading process, what you really need is another way of looking at the charts. Get a realignment of your technical analysis skills with a trading course from TechniTrader.
Hi everyone. Today I want to talk about a market participant group that very people know anything about, and yet you do know them very well, and that is the corporations. Corporations buy and sell shares of stock all the time. They do this for a variety of reasons, and they are a major market participant, especially the very large corporations who are buying and selling stock for a variety of reasons. So today I'm going to go over how the corporations buy and sell stock and how that affects their own stock prices and other stock prices. A lot of corporations are doing what is called a buyback. They were buying back their outstanding shares of stock of their company. So they were going out onto the general market where the public buys and sells stocks, and they were buying back millions and millions of shares of their own stock. Why would they do such a thing? And why wouldn't they just give more dividends? Well, there are a lot of theories and philosophies on how to manage a corporation's stock value. There are many ways that the corporations work very, very hard to keep their stock looking as if it is a great opportunity to buy or invest in. And they work very hard to maintain their stock values. It's not just about earnings and P&E ratios. It's also about where the stock is in its trend and how the corporation can make their stock look more interesting for the average investor who really doesn't know what's going on. When a stock price drops, and there are no small lot investors, no newbie investors wanting to buy stocks, as was the case in 2009 and 2010 when the recession was on and everyone felt that the stock market was going to collapse even further, but it had actually finalized its bear market trough. The corporations were in a quandary. At first, they raised dividends, and that helped a little bit. As they got more profitability, they were able to raise their dividends. But that didn't really help a lot of companies' stocks very much, and there's only so many dividends you can give before it becomes a problem, because if you raise your dividends too high and you have a quarter that is weaker, that can be a problem. And some people like to invest in dividends, but there can be drawbacks to that as well. So the corporations had money, and they weren't going to invest it in infrastructure. What they were mostly concerned with was their stock values. They needed to get their stock values up and moving up so that their stock would look better to the average investor who does not understand the stock market. They engaged in massive amounts of buybacks. Many major corporations bought back millions and millions of shares of their own stock. When they do this, this reduces the amount of shares available on the market to buy or sell. When there's a supply and demand shift, there's more demand and less supply, stock prices move up. It's always about supply and demand. If there's more demand, prices will go up. If there's more supply, prices will go down. It is really that simple. So the corporations, knowing this, bought back lots of their shares of stock. And this excited people, and some new investors and small lot investors and a lot of retail traders bought stocks as the buybacks were occurring. Now, how does a corporation do a buyback? Well, they hire a sell-side institution to do the buybacks for them. So they're hiring a bank or a financial services company, someone who will manage the buyback for them. It's very rare that they would have someone on staff who is a trader, short term, who would have the ability to do that. So they will be hiring the sell-side institutions to do that work for them. The sell-side institutions are happy to do the buybacks for the corporations as they make a lot of money on commissions based on what they sell and how they sell it. Now, when a corporation does a buyback and the sell-side institutions are controlling that purchase over an extended period of time, the buybacks will last anywhere from 6 months to 2 or 3 years. So it is a long-term process where they pull those shares of stock out and buy them and pull them back into the corporation. Now, they can sell those stocks again if they choose to, but it takes a long time. So it's happening over time, but price will be moving up. And it will look like the stock is doing very well. And so a lot of investors will assume that the corporation is doing well. And certainly it is at that point. If they can afford to buy back millions of shares of stock, then certainly the company has enough cash flow to do this. They don't usually do this unless they're having some pretty good earnings and revenues and they have the ability to spend that cash on buybacks. It's a good investment for the company because they're investing in their own company. And as the stock moves up, more and more investors see that. They want to buy the stock. So then the stock goes up further because there's more demand and less supply and so on and so forth. But the buybacks are a very important aspect of the corporations and what they do in the stock market. Corporations can also buy shares of stock so that they have a percentage of investor control where they can take over and acquire a company. They will often do this when they want to acquire a company and they want to control the price. So they may be buying shares of stock of a company that they intend to acquire. And that is a very common way that they do this. They will acquire a certain percentage shares of stock and then they will offer to acquire the company. And we had plenty of this going on also in 2011 to 2015 in the cloud industry. IBM bought a lot of small cloud companies that were public and acquired them because they want to control the cloud industry. A lot of big names. Facebook also is a massive acquirer. It's constantly buying shares of stock of smaller companies and then acquiring them. So when that happens, most of the time, smaller cap stocks have fewer outstanding shares. They may have 15 million or 25 million instead of 3 billion shares as some big corporations have. So when an acquisition is underway and someone is buying the small cap shares of stock, that will make that stock move with fast momentum and a lot of action. And this is very good for retail traders, day traders, swing traders, position traders, because the runs will be very fast and furious. And because the sell-side institutions are controlling these purchases, again, it's very uncommon. Some corporations do have traders on staff, but it's uncommon. It causes a stock to rise in price and makes that small cap look really great because they're about to acquire it. And then what happens is when they are acquiring it or they have signed the agreement for the price they're willing to pay for that company, the stock will gap up to the price that the corporation is planning to buy on it, and then it will just sit there at that price. And if you look at stock charts and you learn to read stock charts, you will see those merger and acquisition patterns of gap and then these little tiny, almost infinitesimal price changes for several weeks to several months that follow. A lot of people that are new to investing make the mistake of buying after a stock has been acquired or merged, but has not actually been merged into the new company yet. There's a time frame between the agreements being signed and when the company is actually acquired and integrated into the other corporation. While the company is in that situation, the price will not move any further. That is the price that the corporation is paying for it. So if you learn to read stock charts, you won't be getting into one of these stocks and then having it sit there doing nothing, and then suddenly you discover, because you didn't realize there was an acquisition going on, that the company no longer is a publicly traded company. It's part of XYZ or whatever corporation bought it. So the second big thing that corporations do that benefits traders and provides opportunities for day traders, swing traders, and position traders is they acquire smaller cap stocks. You just have to be aware of what that pattern looks like and that speculative mode is temporary. It's not permanent. And a lot of people don't realize that speculation is a very short-term situation. It will not go on forever because all businesses cycle, all industries cycle, and the economy cycles. Corporations can and do buy other companies, but they also simply invest in other companies too. A lot of times they will have a portfolio of stocks, just as you might have a portfolio of stocks. And they have invested in those firms with no intention to acquire or merger with that company. They're simply invested in that company because they think that that company is going to grow and that it's a good investment, and there may be some partnering or some reason that they would invest in that company that would be a benefit to their corporation above and beyond the investment value that they would get of ROI over time as the stock moved up. So corporations are a very important market participant group. Not only can you buy their shares on the public exchanges and invest in them long term or trade them short term, they also buy shares of stocks back for their own company to make their stock more lively. The fewer outstanding shares, the faster the stock will run up. So oftentimes corporations, when there's a bull market going on, they're going to be splitting. They'll split their shares of stock, so 2 for 1. So instead of 1 share of stock, you now own 2 at half the price, is what that is. But buybacks were quite unique because during the recession, a lot of corporations were flush with money. They weren't hiring because they had consolidated and they had made things more efficient, and they didn't need to hire at that point. So they took that money and invested in their own stock. Now they may be selling some of their shares of stock back to the market and allowing other people to buy it and then making a profit that way. So they will be buyers at some points and they will be sellers, and they are considered a large lot buyer or seller because they typically will be, when they're in buyback mode, they'll be buying 50,000 shares at a time or 100,000 shares at a time. They're not going to be buying 100 shares. If they're wanting to buy back 10 million shares of their stock or 50 million shares of their stock, it would take a very long time if they only bought 1,000 shares or 100 shares. So they buy large lots. And they show up on the charts as a large lot investor. But they also move the stock price up. The dark pools don't move price. They don't disturb it. So when large lots are moving price up on the charts with the indicators that TechniTrader teaches, so you can see that it is a large lot moving price up, that is one of 2 market participant groups. It's either professional traders trading large lots, or it's corporate buybacks, or corporations buying and investing in that company for acquisition, or corporations buying shares of stock to simply invest in that little company. There are many variables that are going on. So what I'm trying to teach you, and what I'm hoping that you will understand, is it's not Wall Street versus Main Street. It's a very complex market structure with many different market participant groups, buying and selling for various and very different reasons with different share lots, different order types, and different venues. It's not just 1 or 2 market participant groups. And that's so important because the more you understand the market and the more you realize that there's more going on than what you hear in the news or on TV or on the internet. A lot more is going on. A lot more dynamics is occurring in that buy or sell. And that is important because it helps you understand the market, and then it will make you a better trader or investor. The more you understand something, the more you're going to be able to react properly to what's going on and be able to plan and project what you want to do so that you can have excellent trading profits and excellent returns on your investment over time. What is most dangerous in the stock market is that a lot of people are very naive or uninformed. They think they know a lot because they've learned a little tiny bit, and to them it seems like a huge amount that they've learned. Or they learn a few strategies, or they learn about options, or they learn about ETFs, and they think, wow, I know all this information, so I have all this knowledge, when they only have a little tiny snippet of information. To really understand the market, you need a complete education, and that's what TechniTrader provides. We provide stock market courses that teach you about trading and investing, and it gives you a full process that you understand the entire market structure and what is going on, so that when you look at a stock chart or you investigate the fundamentals of a company or whatever you choose to do, you thoroughly understand what you have found and how it will affect the stock and what you should do, whether it should be a short-term trade or a long-term investment. When stocks keep going up and up and up, long-term investments become actually higher risk, but it is excellent for short-term trading. You have many opportunities in the stock market to make money. And most people don't even begin to tap into the massive resources that are available for making money from the stock market. The stock market is the foundation of every other financial market. So if you're considering any kind of investment, start with stocks, because stocks are the easiest to trade and the easiest to invest in, and over time have proven over and over and over again to have the highest return on your investment. Try to learn more about the market. I invite you to come to our website, look at our stock market courses and our syllabuses. A syllabus is an outline that has great detail that explains every factor of what we teach, how we support our students, and how we help them go from the learning phase to simulator trading to trading live in the market so that they're consistently successful. Consistently successful trading starts at TechniTrader. Now, I know there's some of our competitors who've started to pick up that term, but it is ours. We have been teaching how to invest for consistent success for almost 18 years. It's very important for you to remember that TechniTrader is the gold standard in stock market education. Until next week, trade and invest wisely.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who have taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.